Have tuned into IPO Watch. We're going to be talking about the India's third largest online travel company, Yatra Online, where we're going to be talking about the company actually hitting the primary markets with its initial public offering to a tune of around 775 crore. It's going to be divided in two bits, where we have the fresh issue to an extent and also OFS. Of course, we're going to be talking more about the company's financials and the other insight in terms of its business model. But to take the discussion forward, we've been joined by the company's CEO, that is Dhruv Shringi. Afternoon there.
Good afternoon. Good afternoon. Happy to be here, and thank you for having us.
Pleasure is all ours. I'm going to start off straight up by asking you, because you are operating in a very competitive space, that is the online travel space. What distinguishes you as compared to peers like ClearTrip, Make My Trip, Easy Trip, Thomas Cook? How different is your model as compared to that of your peers?
Sure. And that's an excellent question straight off the bat. In terms of our business, there are two legs to our business. One is the consumer business under the Yatra.com brand. The other is the corporate travel business, where we have a platform that's been built specifically for large corporate customers, companies which employ tens of thousands of people to manage their business travel and business travel processes. In that segment of the large corporate customer base, we are the market leaders in India, and we have over 800 plus large corporate customers that work with us currently on our platforms for managing their organization's travel and all related needs. So that's a fairly comprehensive technology solution which has been built by us over the years. It's a solution that will integrate into the company's ERP systems, into the HRMS systems. Their employees will download the app. Their purchasing workflow will sit on it. So once we integrate the system, it's a very tightly coupled proposition which is there for the organizations. That's where we really differentiate ourselves on the enterprise travel solution.
Sure. I also wanted to understand about your price band. There is a little bit chatter around that. The price band is 135 to 140, 42, which is a sharp discount as compared to a price of 236, which the company had issued the share to one of the promoters last year. So, what explains the discount?
Sure. So that issuance which was done was to a holdco, and that was done based on fair market value assessment done at that point of time, right? Where we are today in terms of the pricing on the IPO, it's actually been done based on whatever price discovery has happened through the process with the key anchor investors in the country, right? So, and we're talking about some of the largest institutions. So there is a slight difference between the two. One was more of a private transaction where it got done at fair market value, assessed on DCF methods, etc. Here, the price has been achieved and arrived at through a price discovery mechanism. On a lighter note, I would also say that as an investor, if you look at it, you're today getting the share at a discount to where a promoter had gotten it some time back. So it's not the reverse, right? If it was the reverse, I would be really worried. But here is the other way around, where the price to the retail investor is lower than the price at which the promoters subscribe to it.
It's also because of the underlying fundamentals, right? That is one part of it. But we're going to
Yeah,
dive
I
into
think
it
the
a little
market
more.
environment, absolutely. So I think the market environment is what governs some of these things to a great extent. We are today in a market environment, and based on whatever market forces have determined the pricing is where we've arrived at.
All right. Let's also talk about your operating revenue CAGR in that case and how it's stacked up as compared to that of its peers. For FY21 to 23, it was roughly around 73.8% operating revenue CAGR versus 98 and more than 100% clocked in by Make My Trip and Easy Trip planners. How do you justify that, and what is the road ahead?
Sure. So if you look at that, the one element missing in that when you do that analysis just on a raw basis is that business travel, which is one of the key components for us, only started recovering in the second half of FY23, right? So organizations were shut for the most part of the year, and it's only in the second half of the year that companies started opening up and people started coming back into work and moving away from the hybrid environment. So if you were to look at more recent run rates, right, and I'll give you the number for Q4. So this is the March quarter. For the March quarter, industry in terms of domestic passenger growth grew 4.6%. One of our peers grew 10%, another peer was flat, and we grew 31%. So given that, organizations are now opening up and companies are coming back into work and travel has come back to pre-COVID levels, over the second half of the year, our recoveries turned out to be much faster. So it's more to do with the business mix as opposed to anything else. And now I think we are pretty much back into a more normalized and regular environment. So you will continue to see strong growth from us.
Since the company is the third largest online travel business, in a business which is that competitive, perhaps survival is also a trouble given that we've seen already the impact coming in the COVID year, FY 21-22. The company just turned around in FY 23 with a profitability of 7 crore. How sustainable are these profits? What kind of run rate can one look at? And how
Sure.
different
So,
is, how do you expect to outperform the industry going forward?
right. So in terms of profitability, you're right that at a PAT level we've turned profitable this year. But if you were to look at the operating level, right, which is the EBITDA margins and EBITDA profitability, we were profitable in FY 20 as well. 21 was a bit of a dip. It was a just about a small loss in 21. That was largely due to COVID. And 22 and 23 again we've been profitable at the operating level. So our operating performance has been there. There is obviously depreciation which comes in on account of the investment that has been undertaken to build out some of the technology platforms that we are talking about. But at the operating level, at least we've been profitable for the last 4 years, and operating margins between FY 20 and FY 23 have actually just about doubled. So we are seeing very strong operating performance improvement happening on the back of a lot of work that we are doing to automate our back office centers, to automate a lot of the customer flows and drive down the servicing cost.
So what kind of rate can be expected on the profitability growth rate? That's one. And you didn't specify how do you expect to outperform the industry?
Sure. So in terms of outperformance, firstly, I'll take your earlier question on outperformance. We do have a strong corporate travel business where we are the market leaders. We've got a very robust and market leading technology solution. And what we are seeing is that amongst the Indian corporates, there is today a very burning need to digitize their business processes. So there's been a strong uptake on the digitization and tools, and these would not just be limited to travel, right? Across the board, we are seeing tools for digitization, seeing great adoption by corporate India. So we expect that on the back of that, being the market leaders in the category, we will continue to grow very strongly and outperform competition given the superiority of the product that we have. In terms of where do we see ourselves going from here, if you were to look at our history between 2016 and 2019-20, we were pretty much growing at double the market rate, right? The market was growing between 10 and 12%. We were growing upwards of 24%. So we expect to get back to much faster than market growth rates starting this year as well.
So this 10 to 12% was a year-on-year growth rate that you're talking about?
That was for the industry. That's right. And we were growing at about 24%. So if I look at a 4 year CAGR in that period, industry would have grown at about 24%, at 12%, and we would have grown at 24.
Sure. I'd also want to understand about your listing at this point A. There's hardly a component of OFS. So much of your proceeds are going to be used, the fresh issue is going to be used towards the strategic
Hmm.
acquisition and for customer retention and acquisition and other purposes. But the company's holding company has been NASDAQ listed. So why list in India?
See, NASDAQ was really a listing that we had done a few years ago, almost now coming on to 7 years ago, to facilitate an exit for our early stage shareholders who came in the 2005-6 era into Yatra through an overseas investment route. If you recall, back in those days, the typical norm was to either invest through Cayman or Mauritius, right? And that's one of the routes that we had followed. So this was done to facilitate an exit for those guys. Today, the Indian markets have matured significantly from where we were a few years ago. We've seen a lot of other tech stocks as well come in and be listed out here. In addition to that, Yatra is a household name in India. It's also, one of the dominant players in the category in the corporate travel space. So there is high brand recall of Yatra and our services out here. So this is the home market, and this is literally like a homecoming for us now.
All right. Let's talk about the visibility on your bottom line in that case.
Hmm.
7 crore in FY23. How much is that scalable?
See, we expect that, given the operating leverage in the business, if you were to see from last year to this year, there would be a very meaningful improvement, and our growth in profitability would far outpace the growth in revenue. So if you are looking at, 20% kind of growth in revenue over a CAGR of, the next few years, you can expect profit growth to be at a much faster pace than that.
Let's also talk about your receipts. How do you intend to utilize that? 150 crore goes towards the strategic investment and inorganic growth. Have
Hmm.
you identified any pockets, perhaps, or companies that you can perhaps take over or acquire? And if
Sure.
that's the case, the second follow up question to that is, do you have enough cash in books? How are you going to be funding in these strategic acquisitions that you are planning to go about?
Sure. So in terms of the acquisitions that we are looking at, we have successfully made some acquisitions in the past that we have integrated. These have typically been mid-tier and mid-sized players who have a strong customer base on the corporate side, but maybe don't have the ability to invest behind technology. The market is rapidly moving towards a technology-enabled solution. So what we've done in the past, and we look to continue to do so in the future, is acquire businesses like this which can benefit from adoption of technology, whereby we can drive down the cost and improve margins and synergize these businesses with us. The other avenue is to look at opportunities where there are incremental products and services that can fit into our platform and be cross-sold to our existing customer base. So these are the two, key avenues under which we are looking at M&A.
And how did you say you'd be funding these acquisitions, please?
So part of the acquisition will get funded from the proceeds that we are raising right now. And then obviously, if it's something larger than this, there is always the liquid currency that we have through a stock, which can come in if needed. But the first use would be through the cash that we are raising at this point.
Sure, let's also talk about more about your business model.
Hmm.
Essentially, getting some amount or 28-30% of your amount coming in from B2B business model. But I believe the company would probably would want to foray more into B2C segment, which perhaps is a little more margin accretive in nature. What's your strategy on that?
It's in fact, I'm sorry, the other way around. You will see that a technology enabled B2B solution is much more margin accretive than B2C. B2C, I think one of the perpetual challenges, and this is not just limited to again Yatra, you see this across the board in all the listed entities as well. Cost of acquisition in India on the B2C side continues to remain quite high, and that is a challenge to drive higher profit margins. So from that perspective, we feel the B2B, which is a captive audience, it's a captive market that we have on the corporate travel side. It's a mandated play, and it's a highly technology-enabled play, drives much better operating margins for us than just purely looking at the B2C side. The other interesting facet which is there is that, if I think about the customers that we have, the large corporate customers, their employees, and there are about 7 million people employed by the organizations we service. These are the consuming middle class of India. And by putting our app in their hands or giving them access to our desktop for their business travel needs, we are also able to increasingly convert them into leisure travelers on our platform. And that solves a great customer acquisition challenge that most of the industry faces. So I think that's a great opportunity for us to create a very synergistic view between B2C and B2B. At the end of the day, we are all travelers, right? Whether the reason for traveling might be different, but the person would be the same.
Sure, let's get more into the segmental performance of the company. In terms of the margin profile from ticket business, that's come down from around 11.4% in FY21 to roughly 7.7%. Also, if you talk about the hotel and package, that has also come down from 19.7% in FY21 to 13.6%. What explains that?
So the incremental numbers that you see, the spikes that you see are during the COVID years. If you were to look at the years before COVID, the numbers that you see in FY23 are now pretty close to aligning with where things were in a steady state environment before COVID. During the COVID years, obviously, there was very limited visibility on demand, and suppliers were working quite actively with platforms like ours to try and drive whatever incremental demand they could during that uncertain period. Now, all of that is behind us, and we are back into a steady state environment. So the margins that you see, the 7.7 and the 13, they would be in line with the historical averages of the previous 10 years before COVID.
Where do you intend to focus more? Which of the segments do you think you'd be focusing more? Would it be hotels as compared to that of air travels? Because the margins seem to be a little bit on the higher side for the hotel business. How are you looking at it? What's going to be your mix looking like? Is there going to be a change?
So from a mix point of view, actually, one of the great things that happening in India is that domestic aviation is growing at a very rapid pace. We've all seen the large number of orders which have been placed by the existing airlines. We today have about 700 odd aircrafts operating in India. Almost 2x of that number is on fresh order. So we see domestic aviation continue to drive growth in the Indian ecosystem. We will see a margin shift happening in favor or mix shift happening in favor of hotels, but it's going to be a more gradual shift given that air itself will continue to grow at a very rapid pace.
Sure. Let's also talk about your cash on books, especially the cash from cash flow statement, just from operating activities, also showing a negative number to an extent of 153 crore for the year FY23. What's your guidance on cash flows, and especially why are we seeing that hit in FY23 too?
So in FY23, the hit that you see is on account of increase in working capital. So if you were to strip out the increase in working capital that came in because corporate business recovered very quickly in the second half of the year, you would see a positive cash flow coming in from operations. So it's more on account of the base effect that in FY22 there was no corporate travel, and then suddenly in FY23 second half corporate travel picked up in a big way. That's what led to working capital deployment. Now that we are into a normalized scenario, you won't see that one-off swing that you saw last year.
All right, let's talk about the kind of potential, revenue potential that the company is scalable potential of. In terms of that, how much growth are you targeting from organic versus inorganic?
So I think, from an organic perspective, also there is tremendous amount of growth opportunity in India. As I mentioned, domestic aviation is growing very rapidly. We've got a very young population, disposable income coming into the hands of the younger population, the millennial population. So that's really driving a big consumption trend in favor of travel. So I see the industry as an industry which has about, a decade to 2 decade kind of runway right now of high growth.
All right, Mr. Dhruv, perhaps a bit of
Sorry. Hmm.
no worries. You can probably let us know the kind of revenue rate that we're looking at in terms of the scalability of the business. If you could provide more color on that, that should really be fine. We can probably then talk about more in terms of the organic, inorganic strategy that you were talking about.
Sure. So if you look at gross bookings, last year we had about 6,740 crores of gross bookings. Uh, we, as I said, expect to grow at upwards of 2x of the market between that kind of a range. So we should continue to see strong double-digit plus growth for a number of years. I don't think it would be right for me to start giving forward guidance at this point. But in terms of just indexing as to where we were and what we were doing pre-COVID, right? We were growing at much faster than the market, and that's what we expect to do going forward as well.
What gives you the confidence of a business model which is competitive in nature, and of course in the markets where we've seen some amount of pressure already creeping in the names, even in terms of the stock performance that we've seen in the last 1 year? How scalable you think businesses like yours are? Do you expect to diversify in any other stream, so to say? How are you looking at it?
Sure. So if I look at our corporate business firstly, our corporate business tends to be a very sticky proposition given the kind of technology integrations that will happen within the customers. In fact, 91 out of our top 100 customers have been with us for more than 3 years. So we have a fairly robust way of retaining customers and a strong lifetime value of our customer base. In terms of looking at newer avenues for growth, so obviously, it's like a platform play. Once you deploy a platform in a customer, it's then very easy and at a much lower cost to sell new and incremental products with high operating leverage and high operating margins. So that's the way we are thinking about this. The platform's already been deployed. Now it's about cross-selling more and more products and services on that platform to the customer base and get a larger share of wallet. On a, on a slightly different note, we've also, ventured into the freight forwarding side of things. A number of our large corporate customers are big spenders on freight, and the freight industry is fairly opaque to that extent and very fragmented. So we feel it's an industry which is right for technology and ripe for technology disruption. And this is the seed that we are planting for the next decade, right? So this is something that I feel over the next 5 to 10 years could turn into a substantial business by digitizing the freight forwarding industry in India.
All right, Dhruv, we're just going to leave it at that. And thank you for
Sure.
taking out the time and speaking to us.
Thank you. My pleasure. Thank you.
All right, well, this is a wrap. Thank you so much for tuning in.
Thank you. Great talking to you. Thank you. Bye.
Pleasure.